Hello and welcome to the Legal Super podcast, where we make super simple, practical, and hopefully interesting. Today we're diving into all things investing in super. And that's why we're joined by Charith, Senior Investment Analyst here at Legal Super, who will break it all down for us. Thanks for coming, Charith.
Great to be here.
To start, can you tell us a little bit about what you do?
Sure. In my role, I look at different investment opportunities and help shape Legal Super's overall investment strategy. In practice, that means ensuring our members' money is invested in a way that puts them in the best position to meet their retirement goals.
Super is one of the biggest investments most of us will ever have, but it's also often the least understood. Now, we know that money is going in each and every payday, but what actually happens once it lands in your super account? How does it get invested?
Every time money goes into your super, it's invested across a range of assets like shares, bonds, property, infrastructure, depending on the investment option you've chosen. The goal is to grow this money over time so that by the time you retire, you've got much more than just your contributions. Diversification and active management go a long way in helping grow these funds over the long term. So what happens each payday is really just the beginning. It's what your contributions do once they're invested that makes a real difference in retirement outcomes.
So for someone who's never really thought about it, how is investing in super different to investing outside of super? Like, for example, buying shares or ETFs?
Super is really built for the long term. So that means the rules, the investment strategies, and the tax concessions are all built around that time horizon. That's why compounding is so powerful inside super. Secondly, members get access to a broader mix of investments than you can get access to on your own. So things like infrastructure projects, private equity investments are generally hard to access as an individual investor. And finally, having a super fund team manage and diversify your money means you don't have to make the day-to-day investment decisions yourself. It's about building a resilient portfolio that works for you in the background to grow your retirement balance over time.
So Charith, you mentioned compounding. Can you explain to our listeners what that actually means?
Compounding means your contributions aren't just sitting there. They're invested, they earn a return, and those returns are then reinvested. So over time, it's like a snowball that gets bigger and bigger.
Mm-hmm. So it really is like an exponential growth when you think about it. So I don't know, if we take an example of $100 invested, and if we assume a 10% return on that investment, then the following year you might have $110. But then the year after that, instead of getting $10, you're now getting $11 because now that's 10% of the $110. So you can really see over time how that can grow and have such a big impact, especially when you're thinking long term. Super can most of the time is invested for decades, right?
Exactly right.
So when it comes to super, you hear terms like conservative, growth, and my super balanced. But what do those terms actually mean in practice?
The different options are simply mixes of investments, each with its own balance of risk and return. A conservative option leans more heavily towards defensive assets like cash and bonds, so the returns are more stable over time. Whereas on the other end, you've got your growth options, which have shares and more growth assets, so your returns can be more volatile. And then balance sits right in the middle. It's a default option for many of our members because it strikes a great balance between growth and stability.
Mm-hmm. So you'd say most people actually fall into the My Super Balanced option. Majority of people are invested in that if they haven't actively picked their option. Is that right?
That's right. You default into the My Super Balanced option, but it may not be the most suitable option for you. And that's why you've got to have those conversations with client service managers.
And I feel like when it comes to super, knowledge really is power. So the more you know, the more informed the decisions that you'll be able to make.
It's like everything in life, right?
Yeah, exactly. So when you come across an investment, how do you know that it's the right investment for a Legal Super member or for one of Legal Super's investment options? What criteria does that investment go through?
It really depends on the investment, but broadly speaking, firstly, we look at the long-term return potential. Can this investment generate returns over time for our members? Then we think about the risks. What could go wrong? How could that affect the portfolio? We also look at diversification. Does it bring something different to the mix so members aren't too concentrated in one area? Finally, we assess whether the investment aligns with our broader objectives and values as a fund. It's about making sure each piece that we bring into the portfolio adds something meaningful and can grow over time.
Can you give us an example of one of legalsuper's investments?
Good example is Melbourne Airport. For members, investing in something like an airport means the returns are very steady and can grow over time. It's also critical infrastructure, so it needs...
It'll always get used, right?
Exactly right. Yeah. And there's a willingness to make sure that it's maintained and developed to ensure that it meets the growth and the requirements of the population, as things like passenger demand and freight demand, they all matter. So you'll see additional terminals, additional runways all come into the mix over time. And that's great for members because it means that not only will returns for airports grow over time, it ensures it's a resilient asset that can stand the test of time as well.
And so stable. And I mean, if you've been to Melbourne Airport recently, it's packed there, so probably a good thing for us too.
Sometimes it's not as great to be a passenger when there's development going, but I can assure you that it's great for the future.
So markets go up and down, and that can sometimes feel pretty scary. I know in April, early in the year, when we had all the tariffs, that people saw their super balance drop by thousands or even tens of thousands overnight. And I mean, that can be pretty scary to see that. How do you manage volatility?
Volatility is part of the journey. But the key thing to remember is that your super isn't just invested in one asset. It's spread across a range of assets like shares, bonds, infrastructure, property, and a lot more. That diversification helps cushion the blow when markets do get volatile. Think of it like a fruit basket. If you've bought just apples and the apples go bad, you've got nothing to eat. But if you've bought apples, oranges, bananas, and the apples go bad, you've still got the oranges and bananas left to eat.
That's a really good way of explaining it. So for someone who's invested, for example, in the My Super Balance investment option, which is the default option, how many shares are they actually invested in? Are we talking hundreds? Are we talking thousands? What is actually the extent of the diversification?
I don't have the number off the top of my mind, but it's definitely in the thousands.
Yeah. Wow. So we're not just talking apples, oranges, bananas. We're talking thousands of, small parts of either organizations, or property, infrastructure that you're invested in. So the diversification is really there. That's right. And it's across the globe as well. So we've got investments in Australia, in the US, across emerging markets, and it's in different sectors. So there's a lot of diversification that we think about, not just as an individual name, but from a regional perspective, sector perspective, and a lot more. Yeah, so if some investments do not so well, you can kind of not expect, but have peace of mind that other investments may do better and so on. That's right. Now, I think another relevant topic here is dollar cost averaging. You hear that term being thrown around. Can you explain to our listeners what that actually means? Dollar cost averaging is the concept that because contributions go in regularly, you end up buying investments at different prices over time. When markets fall, your contributions buy more units at a lower price. And then when markets rise, you buy fewer units at a higher price. Over time, this averages out and smoothens your ride. I think a really interesting topic here is payday super. Now, I know that doesn't kick in until about July next year, 2026, but that means that organisations will have to pay super every payday, which for most people is every 2 weeks. And currently it's only once every quarter. I know some businesses have definitely started to do that early, which is great. But I think that will be great for dollar cost averaging because members are going to be investing more regularly, right? That's right. The sooner contributions go in, the sooner that they're invested, and the sooner they go into growing their retirement balances. So it's a very positive change. Because I guess they kind of compound over time, but then also using that dollar cost averaging, you're buying units at different prices, which is what we want here, right? Exactly right. So what's impacting investments right now, and where do you see the opportunity? A big theme right now is technology, particularly the growth of AI. I'm sure you've used ChatGPT and everything else in between. But with those capabilities, there's a very high demand for compute and power and storage. And that's where things like data centers comes in. Huge opportunity there. There could be. We're doing a lot of research into the area, particularly the powering of these data centers.
We think powering these data centers sustainably is critical because without things like renewables, the carbon emissions from the demand for these data centers could really increase our carbon emissions over time.
So it's about finding that balance, right?
That's right. It's about finding the balance, and there's a lot of moving parts as well with changes in policy decisions, environmental pressures, as well as the need for these types of technology. So we've just got to make sure we balance all those things that are happening around the world, and also ensuring that our members' money is invested for the long haul. So we're not forgetting about that fact.
Yeah, very exciting time, but sounds like there's lots and lots to consider.
There's a lot to learn.
So for someone who wants to actively choose their investment option, which we encourage everyone to do, what could they consider when it comes to picking an investment option?
First is your time horizon. How long is it until you'll get access to your retirement savings? If you've got decades until you get access, then a higher risk option might be suitable, given you've got time to ride out the ups and downs of a market. If you're closer to retirement, you may choose to lean towards a conservative option to reduce risk.
And the second thing, I guess, is your risk appetite and how comfortable you are when the market does fluctuate, right?
That's right. Your comfort with risk is really important. I've got friends who are more risk averse, so they tend to lean towards conservative options. But on the other end, I've got friends who are also a lot more aggressive in their investing, given they've got more time to ride out the ups and downs.
So it all comes down to your personal preference as well at the end of the day.
It does. It really does.
So I actually had this question a few years ago where I was in the My Super default investment option and I wanted to go for a high risk investment option just because I know that I still have decades until I can access my super. So I was wanting to take on more risk because I have time to ride out those market fluctuations. Now, when you change investment options, I'm assuming you sell and buy shares practically. So is there a way, or should you consider the time in the market when you do that? How does that actually work?
It's really hard to time markets at the end of the day. So I think time in the market definitely matters a lot more than trying to time the market.
So for example, if you wanted to change your investment option from a balanced option to a high growth option, you would just pretty much practically want to do it as soon as possible so you have that compounding effect. Is that right?
Yeah, that's right.
Charith, thank you for breaking down what sometimes can feel like a really complicated topic. I know I've learned a lot today. Now, if there's one thing you'd like our listeners to remember about investing within super, what would it be?
Think long term. Super is designed to grow over decades. So I think choosing the right option really does make a difference to your retirement outcomes. And if you're not sure, that's okay, because our client service team is always here to help you.
And those appointments with the client service managers, they're free of charge, they're free of obligation, and they'll actually meet with you one-on-one and explain to you about the different options that you have so you can really have confidence with the decisions that you're making. Great point to finish on, Charith. Thanks again for joining us.
Thanks so much for having me.
All information in this podcast is general in nature. Please refer to the LegalSuper PDS and TMD available on the LegalSuper website before making any decision. Past performance is not a guide to future performance.